Stock Price Forecasting, presented by Amy Fiemel. Financial investing is an effective way to put your money to work and potentially build wealth. Investing in stocks is a popular option because they offer a return on investment when stock prices increase. Though average annual stock returns vary greatly between each company, the stock market average is approximately 10%. Stocks have the potential to be very profitable. However, they can also be volatile and contribute to financial loss. While it may not be possible to avoid all losses, risk management can help mitigate some. One way to minimize the risk is through stock price forecasting. Stock analysts are often employed by banks, investment firms, and analysis companies to make predictions about companies and their future performances. With access to company financial statements, quarterly meetings, company management, and key customers, stock analysts conduct surveys and research to gain additional insight about the companies and how they are performing. They publish their findings in a report that includes projections of the company's revenue, earnings per share, a 12-month price target, and a recommendation rating. The 12-month price target is what the stock price is forecasted to be in a year, and the recommendation rating tells investors whether they should buy, sell, or hold. Though I do not have access to the same resources available to a stock analyst, I will be using historical stock prices to answer the following questions. What is the daily return of the stock on average? What is the moving average of the stock? Are any of the stocks highly correlated? What is the risk of investing in each company? And finally, what is the 12-month price target for each company? My analysis focuses on stock data from 4 companies in the communications sector: Disney, Comcast, Netflix, and Viacom, which I obtained from Yahoo Finance. Here is an example of how the historical data looks and the variables that are included. The first column is date, which is the date the stock price was recorded. The next is open, which is the price of the stock when the stock market opened for the day. The next 2 are high and low, which indicate the highest and lowest prices that the stock reached on that given day. Then we have close, which is the price of the stock when the market closed for the day, followed by adjusted close, which is the closing price adjusted for dividends and splits. And finally, we have volume, which is the number of shares that were traded on the given day. Here's a look at the history of closing prices for each company. We begin with Disney in January 1962 with a closing price of 10 cents and a current closing price of $182.76. Comcast is next, reaching back to March of 1980, with a closing price of 10 cents and a current closing price of $54.40. Next is Netflix, beginning in May of 2002, with a closing price of $1.20 and a current closing price of $508.78. Finally, we have Viacom in December of 2005, with a closing price of $26.70 and a current closing price of $40.73. Now let's look at their overall change in price. Here we can see the overall change in price is greater for companies with longer time periods of historical data. So I observed different time periods starting with the last 5 years. Disney had a 5-year price increase of 77.5%. Comcast increased by 95.5%. Netflix had the largest increase of 362.7%. Viacom decreased by 12.7%. Next, I looked at the change in prices over the last year. Over the last year, Disney stock price increased by 23.3%. Comcast increased by 19.9%. Netflix increased the most again by 54.3%, and Viacom continued decreasing by 3.2%. Now let's look at how these companies are doing in the current year. So far this year, Disney stock increased by 2.9%. Comcast increased by 7.7%. Netflix stock decreased by 2.7%. And Viacom increased by 11.3%. Now let's look at the daily return of each company. Over the last 5 years, all 4 companies have had positive average daily returns, though very minimal. Over the last year, each company had a slight increase in daily returns compared to the last 5 years. So far this year, Viacom is the only company that had an increase in daily returns from the previous year. Though daily returns for Disney and Comcast decreased from the previous year, they are still positive, unlike Netflix that has a negative daily return. Now let's look at the moving average. Here are the 20 and 100-day exponential moving averages, which is the average stock price over 20 and 100-day time periods, and how they compare to the actual stock prices. The 20-day averages follow the actual prices more closely and have a more analytic benefit to short-term investors. The 100-day averages smooth the prices to provide a bigger picture of the stock's performance and may be more beneficial to long-term investors. The 20-day moving averages for Disney, Comcast, and Viacom show an expected decline of immediate future prices, while Netflix shows an increase. The 100-day moving averages show an expected increase of immediate future prices for Disney, Comcast, and Netflix, and a decrease for Viacom. Now let's look to see if there are any correlations between the closing prices of these companies. Looking at the closing prices from last year, we can see Disney and Comcast are highly correlated, with a correlation coefficient of 0.95. Disney and Viacom are also highly correlated at 0.86, as well as Comcast and Viacom at 0.84. For the current year, Disney and Comcast remain highly correlated at 0.84, but not as high as the previous year. Now let's look at the risk of investing in each company. I considered two metrics, dollar volume and the standard deviation of the daily percent change. Stocks that are both thinly traded and low priced increase the investment risk. Thinly traded stocks are those with trades fewer than 400,000 shares per day based on a 50-day average. To account for thinly traded and low-priced stocks, I calculated the dollar volume of each stock. Dollar volumes of less than $20 million indicate increased risk. The standard deviation tells how far the investment fluctuates from its expected return. High standard deviations can indicate market volatility. Therefore, the greater the standard deviation, the greater the risk. To calculate the dollar volume, I multiplied the closing cost by the volume of shares traded each day. Over the past year, each company has maintained a dollar volume exceeding $20 million, as indicated by the dashed line. Therefore, the increased risk associated with thinly traded and low-priced stocks does not apply to these companies. Here is a visual that shows the expected return versus the risk from 2020 to the present, where risk is the standard deviation of the expected return. Now let's look at how the expected return and risk has changed in the current year. First, let's look at Disney. As we can see, both the expected return and risk decreased. Now let's look at Comcast. Comcast's expected return increased while the risk decreased. Here's Netflix. The risk looks similar as it did the previous year. However, the expected return decreased. Finally, we look at Viacom. Viacom had an increase in both expected return and risk. Now let's look at all of them together. Here we can see Viacom has the highest expected return, but also the largest risk. Comcast has the lowest risk and highest expected return compared to Netflix and Disney. Finally, I trained and tested two models, autoregressive integrated moving average and long short-term memory. First, I split the data into a training and test set. The training data consisted of closing stock prices from 2015 to 2019. The test data consisted of closing stock prices from 2020 through April 22, 2021. I used the root mean square error to evaluate the performance of each model. I chose the model with the lowest RMSE to forecast the 12-month price target for each company. Here are the results I obtained using the autoregressive integrated moving average model. The model performed the best on the Comcast stock, with a root mean square error of 0.91. Disney, Netflix, and Viacom had root mean square errors of 3.56, 13.14, and 2.22 respectively. Now let's look at the results of the long short-term memory model. Like the other model, this model performed best on the Comcast stock, with a root mean squared error of 1. Disney, Netflix, and Viacom had root mean squared errors of 7.13, 14.1, and 2.32, respectively. Here we can see the results of both models. Because the autoregressive integrated moving average model performed slightly better, I used it to forecast the 12-month price target for each company. First, let's look at Disney. The current price is $182.76. The forecasted 12-month price target is $203.57, which is an 11.4% increase. Comcast stock has a current price of $54.40. The forecasted 12-month price target is $60.57, which is an 11.3% increase. Netflix, which has a current price of $508.78, has a forecasted 12-month price target of $618.80, which is a 21.6% increase. And Viacom, which has a current price of $40.73, has a forecasted 12-month price target of $38.94, which is a 4.4% decrease. Based on my analysis using historical stock prices alone, Comcast appears to be the better of the 4 companies to invest in. Comcast had the lowest associated risk and also had the lowest RMSE of 0.91. This means my predictions were off by an average of 91 cents. However, I would also suggest to proceed with caution. Stock price forecasting is only one of many risk management strategies. Most investment professionals would probably agree that portfolio diversification is the most important strategy to minimize risk. Portfolio diversification involves dividing investments across various sectors, industries, and investment types. This way, losses on a single asset will be offset by the overall gains of the portfolio. It is also important to be aware of the risks that can affect stock market prices, such as those associated with the economy, an industry, or even the entire stock market. These may include factors such as inflation or deflation, developments in technology, and stock market crashes. Thank you, and I hope you enjoyed my presentation of stock price forecasting.